Welcome to AIADA's AutoTalk. I am Dan Barson, your host for today's program. We are proud to welcome Aaron and Ryan Kerrigan, founders of Kerrigan Advisors. Kerrigan Advisors specializes on buy-sell representation, capital raising services, and consulting on open point applications and accounting practices to position for a transaction. The publisher of the industry-leading Blue Sky Report, we're excited to welcome AIADA Affinity Partners, Aaron and Ryan Kerrigan. Welcome to the program.
Thank you, Dan, for the kind introduction. We very much appreciate our relationship with AIADA and support the very important work that the organization is doing on behalf of its members. After multiple years of clear sailing, I think very few could have predicted the risks to a free and open trading environment that we see today. So it's vital that AIADA is active, well-funded, and prepared to work on behalf of the dealer body to keep trade flowing. As Dan mentioned, we are one of the most active buy-sell advisors in the country, generally working on some of the larger and more complex transactions in auto retail. And this provides us a lot of data and a lot of perspective on the current status of the transaction market. As promised, we're going to discuss the following in today's call: an overview of who is buying in today's buy-sell market, including a discussion of new investors in auto retail, why more sellers are coming to market today, and the impact of rising seller volume on today's blue sky values and multiples, and the importance of dealership real estate to most transactions and the effects of image facilities on blue sky value. Before we jump into the content, let me provide you just a bit of background on our firm for those of you that do not know us. Since 2015, we have represented on the sale of 72 dealerships all across the United States and Canada. In fact, we just closed a transaction yesterday selling CarPro's Kia of Carson, California, which is far and away the highest volume Kia store in the U.S. network, and that transaction represents the largest ever for a Kia franchise. Consistent with that transaction, we focus on representing sellers when they decide the time is right to sell. We've had the privilege of selling 5 of the top 100 groups in the country, all across the U.S. in the last 5 years. The most recent of those top 100 groups being the sale of Grossinger family's 15 franchises in Chicago, which closed this past spring. In recent years, we have generated more than $1.5 billion in client proceeds from the sale of goodwill and real estate. And lastly, we are fully licensed by FINRA to do all forms of transactions, including capital raising and stock transactions. We believe this becomes increasingly more important as our industry starts to see very significant consolidation. We think the next generation of industry leaders will need to think beyond the family balance sheet and increasingly partner with deeper pools of professional capital. So in addition to our sale process, we are broadening our services as a firm to raise capital on behalf of larger dealership groups seeking significant outside capital to continue to grow their businesses. In what may be different from many AIADA members' experience, we do not take listings. We work only on behalf of clients who have exclusively engaged our firm to run the sale process from beginning to end. Before there's a decision to go to market, we spend the time necessary to make sure that that is the right choice, and then spend significant energy getting ready in preparation for a successful sale process. We're proud to report that all of our prior clients are referenceable clients that can talk about how we run our full-service sale process, with the objective of getting the best term and price for our clients, and most importantly, getting a transaction done. We believe that dealerships are far too valuable to be sold any other way. Some of you may know us from our quarterly Blue Sky Report, which is now sent to over 8,000 people in the automotive industry spanning 35 countries. Over the years, we have frankly been surprised by the intense interest in this report outside the United States, but it has led to some very interesting conversations and even transactions. We've been approached and had conversations with automotive strategics from Europe, Canada, Mexico, and Asia about the U.S. auto retail market, and some of these players have already made investments in our marketplace. For example, in the Grossinger transaction I referenced a moment ago, the buyer was Auto Canada. This represented Auto Canada's first acquisition outside of Canada. Similarly, we recently announced the sale of Toyota and Subaru of Wilsonville, Oregon, also to a Canadian firm making its first acquisition in the United States. Based on our conversations, we foresee more cross-border transactions in U.S. auto retail in the months and quarters ahead. With that, I'm going to hand the reins over to Erin Kerrigan, my partner, who's going to walk through the most recent transaction market metrics. Erin?
Thank you, Ryan, very much for that introduction. As you can see, we're very busy as a firm, and that brief commercial is a good starting point into what's going on in today's buy-sell market. As you see, we are going to be employing a summer theme to today's webinar. There are certainly similarities between the unpredictable weather of this very hot summer season and the buy-sell market. Let's get started with answering a question on the buy-sell market in terms of whether it's heating up or cooling down, because we are often asked this, especially with some of the changes we continue to read about in the industry. Interestingly, after the first quarter of this year, it was hard to answer that question directly because, as you can see, we actually did see a decline in the number of transactions in the first quarter, and this was reported in our first quarter Blue Sky report. In fact, the transaction activity declined 35%. We were really surprised by this data as a firm because we did not see a decline in activity, and so we dug a little deeper to understand why would it be that the number of transactions went down. And what we found was that while the number of buy-sells did decline, the number of franchises that sold did not, and that was in large part due to the fact that multi-dealership transactions rose quite considerably in the first quarter and actually continued to do that as we finally looked into this last quarter's data. You can see that including the second quarter's data, transaction activity has now surpassed 16 and 17's first half, such that the first half of 2018 is tracking to be almost on par with 2015. And this matched more closely with what we were seeing in the marketplace in the deals we're working on. What this means is that two things. First, we did see a huge uptick in buy-sells in the second quarter, but also that the transactions that are getting done are more often including multiple franchises. In fact, multi-dealership transactions increased 43% in the first half of 2018 compared to 2017, and the average transaction represents just about 2 franchises, meaning the number of franchises represented in each deal is continuing to grow. So as you'll see when we discuss the buyer and seller trends in the market, our firm does not expect the consolidation activities to slow anytime soon. If anything, we think it could very much accelerate, and we do believe this is a reflection of a very hot rather than cool buy-sell market. Part of the reason we believe that we're going to see more transaction activity is because the public auto retailers, for the most part, are back in the game, armed with higher stock prices and tremendous access to both capital from operations and from the financial markets. The best indication of the health of the public auto retailers, in our humble opinion, is the Kerrigan Index, which tracks the valuations of the 7 publicly traded auto dealership stocks, namely AutoNation, Penske, Lithia, Group 1, Asbury, Sonic, and CarMax. Now, for those who are not familiar with the index, the purpose of it really is to identify and assess drivers impacting changes in these companies' valuations, because these are the largest retailers in our industry for the most part. And so when their valuations fluctuate and their blue sky fluctuates, it's a good indicator for the industry as a whole. And these companies are marked to market every business day, so we know exactly how much their blue sky is worth right now, and that can be very helpful and insightful as we look at the industry. Now, if we look at the history of this index, interestingly and not surprisingly really, it hit a high in 2015 when industry sales and profits peaked. It then took a pretty deep dive when investors suddenly realized that our incredible sales growth coming out of the recession was actually starting to end, and we were hitting this sales plateau. What's interesting to us is that since the index hit its low in the beginning of 2016, it has rebounded quite nicely, up over 30% since that time. And this is somewhat surprising and counterintuitive because the industry is still in a sales plateau environment, and yet these companies are seeing their valuations rise. Kerrigan Advisors believes Wall Street is clued into two extremely important investment theses regarding the future of auto retail. The first, the consolidation will continue at an increasing pace, presenting a tremendous growth opportunity for the consolidators through accretive acquisitions. And second, that the technology and digital changes coming to auto retail will disproportionately benefit the largest dealership groups as they add economies of scale and economies of scope. With this in mind, it is not surprising to see that some of the publics did, of course, increase their acquisition activity and spending in the first half as compared to the first half of 2017, and they're frankly being rewarded for doing so. Those that are the most active in buy-sells in our analysis tend to have the higher multiples, valuation multiples in the industry, Lithia being the most obvious one, and they are obviously the most active right now. In the first half of 2018, you can see that the publics increased their spending by 4%, and if we were to annualize their first half spending, they would actually be above 2015's level, and that would be a pretty significant accomplishment because that was a very active year, and the only other year that surpasses that is 2014, which was marked by Lithia's acquisition of DCH. So that's a little bit of a disproportionate view that was a one transaction that really resulted in such a big year. So 2015 was a very active year. 2018 could be as active based on the spending levels that we are seeing year to date. Now, even though we do look at the publics, we do analyze the Kerrigan Index, of course, the publics are not the major buyers in the market. Interestingly enough, even though many talk about them a lot, 89% of franchises in the first half were acquired by private dealers. And this is what is very interesting to us in that when we think of private dealers, we think of the traditional dealership group buyer. But actually what we're seeing is this category of private dealers is expanding to include outside capital who are coming in and buying dealerships or backing private dealer groups in their acquisitions of dealerships. As Ryan mentioned, we have engagements with growing dealership groups that are hiring our firm to help them to access this growing pool of outside capital that is very interested in investing in auto retail. But we're also seeing international investors and international groups coming into the U.S. market like Auto Canada or Trophy Automotive Group, and all of these groups that are funded by international investors or international auto retailers who want exposure to the U.S. auto retail market and are interested in acquiring U.S. auto dealership groups. We believe this is a theme we will continue to see as an industry. So as you can see from this slide, not surprising, of course, with private dealers driving the activity level in the marketplace, the number of private dealership groups with over 11 dealerships and is growing tremendously, growing 63% since 2010. In terms of the market share of franchises, what you will see in terms of the market share, as you can see in terms of what franchises are being acquired, what you'll see is that basically domestic franchises have been taking share away from to some degree from import luxury and import non-luxury, and that's in the bar graph on the left-hand side of this slide that you can see. Interestingly, if you look at the franchise turnover rate, imports actually have much higher turnover rates, meaning that the number of franchises that sell relative to the total number of franchises out there is higher for import luxury and non-luxury. However, when you look at the total market share, because there are so many more domestics, they do have a higher market share rate. What we're finding in general is that we have buyers very much interested in top import non-luxury stores and top domestic stores, think Ford and Chevy, and think Toyota and Honda and Subaru in terms of the ones that we see most actively of interest in trading. We don't see as many of the top luxury franchises trading, and part of that has to do with the valuation multiples, because the reality is that as interest rates rise and cost of capital rises, the multiples associated with top luxury franchises, import in particular, are so high that it becomes harder for some to justify the pricing. And in our experience, sellers have no intention of discounting because they don't have to, and so you just see fewer of those top luxury franchises trade in the market. Okay, I would be remiss if we, of course, didn't talk about the effect of tariffs, and we're going to be talking about this throughout the presentation today, and especially as we talk about multiples. But what we are seeing is that the discussion at this juncture is not affecting the buy-sell activity. However, if we don't gain a resolution to the tariff situation, we are going to expect some effect on the buy-sell activity, and ultimately a pretty dramatic effect on blue sky values if the kind of tariffs that are being discussed in the marketplace today were to come through. So not only is this, of course, a problem for car sales, this is a big problem in our view for the value of dealers' businesses if we were to see a significant tariff put in place for import vehicles and import parts. Okay, with that backdrop, let's talk about what is driving sellers to market. What we are seeing is that more and more sellers are coming to market because they perceive risk to their blue sky on the horizon. In many cases, these dealers, particularly those who are at, near, or far past retirement, of course, no one on the phone fits that bill, but for those that are out there that are thinking about retiring or planning for their own estate, they are aware that our industry is seeing some of the earnings decline, and as a whole, industry earnings are declining, and for some more than others. Many of these dealers do not want to miss their window of higher industry earnings to sell their businesses. You can see that the average dealership earnings declined about 2.4% in 2016 and further almost 5% in 2017. We've been at somewhat of a plateau going into 2018, and what we find is that these sellers really have some perspective that even though these earnings are down somewhat, they're still very high on a historic basis, and their blue sky values, which are based on the earnings, are also very high on a historic basis. These sellers want to make sure that they are capturing the values that we see in the industry today, because they're worried that they may miss their window in the future if the earnings or the multiples were to decline. Of great concern to many of these dealers is their lack of control over their profitability, which is increasingly driven by a dependence on the industry on OEM incentives and stair-step programs. This graph here from NADA shows the average dealer's operating profits before other income. And you can see that this is a pretty startling graph, because what it shows is we had pretty consistent operating profit for quite some time, and then it really fell off in 2016 and further in 2017 and continues to fall off in 2018. And what this means is that more of the industry's profits are being driven by the OEM, and for some dealers, that makes them feel that they are in less control of their business and is pushing some to sell, in our experience. Now, another reason dealers are considering going to market is because they are concerned about the changes that may affect the auto retail business model in the future, whether that is online sales, subscription models, or further into the future, electric cars, with almost no service requirements, as we know, or even further into the future, autonomous vehicles. These dealers are reading the headlines and realizing that while we do not know when our industry will change, it is highly likely change is coming, and it will be harder to navigate change without scale. I think this quote from Prime Motors really is emblematic of how some are thinking. What they said, Prime being one of the largest groups in its region with over $1 billion in sales, David Rosenberg, the CEO of Prime, said in his reasoning for selling is that with everything going on in the automotive business today, you need to be super aggressive, have as much scale possible, and be an efficient retailer of automobiles. To do that, you need a lot of capital and a lot of size. Now, keep in mind that, again, this was a very sizable group, and yet they didn't feel they had the scale to succeed in an evolving industry. In addition to these drivers, some sellers are also focusing on rising interest rates, which are most evident now in the rising cost of floor plan, but are also showing up in the rising rents that we're seeing. In fact, in 2018, average rent per car sold is now near levels we saw during the recession. That brings me to an important trend that is also driving some dealers to sell, which is the value of real estate. Increasingly, real estate is a very hot topic in our industry, and that's not surprisingly because the rise in real estate prices in today's market is frequently offsetting any declines that we're seeing in blue sky values, resulting in total enterprise values that are above even 2015's level. So sellers who are considering a sale and own their real estate are often finding that, again, they're selling at peak transaction values when they include their real estate. But of course, this will not last forever. Typically, as interest rates rise, cap rates, which reflect the income yield on real estate, follow suit, resulting in lower real estate prices. This is primarily because buyers have higher borrowing costs when interest rates rise, and they then have higher return on investment thresholds. So, given the risk to real estate prices, what we are finding is that more dealers who are selling are choosing to sell their dealership real estate along with their dealership because they do not want to find themselves with property that is worth less in the future. This example on this slide shows the potential effect of rising cap rates. If cap rates were to increase by 5%, for instance, in this example, the value of this real estate would decline 42% if the real estate was valued based on a cap rate basis, which typically if you lease a property for a very long time, the valuation is driven more on that lease income rate than it is per se on an appraisal. And so this is a very important factor that dealers are considering as they consider whether they're going to sell their real estate or lease it back to a buyer. As you can see here, it is clear that cap rates are trending upward. And again, think of a cap rate as a bond yield. As the yield that an investor requires goes up, the value of that asset usually goes down. Okay, now that we have reviewed the seller's perspective and we've gotten this PowerPoint working, let's now talk about the buyers, most of whom see a real opportunity to ride the consolidation wave to great success. Now, as I've already mentioned, more sellers are coming to market, so buyers are seeing a sizable increase in deal flow today. These buyers are less concerned by the sales plateau. Many are aware that our prior sales plateau lasted a good 8 years, which would put us about in the middle of a long run of high sales, with room to run because the economy is very strong and continues to grow. Furthermore, many of these buyers, what they love most about our industry is not the new car department, but rather what they love is the other parts of our industry which show such high margins. You can see here that new vehicle sales margins are, used vehicle sales margins are 2 times higher than average new vehicle sales margins. And parts and service, the darling of our industry and responsible for about 50% of our gross profit, has margins about 8 times. These are the parts of the business, the used car and the fixed operations, which are so attractive to most investors, particularly given, again, that fixed operations is a recurring revenue business, high margin recurring revenue business, and one that continues to grow. In fact, it's up, on average, fixed operations revenue are up 50% since 2010, and unlike new vehicle sales, continue this pace of growth, especially given the number of new vehicles that are coming off of warranty and getting that sweet spot of our industry, which is the customer pay period of when customers are having to pay for service and parts. We're also seeing, of course, vehicles in operation increase as a result of the tremendous amount of sales, so that too should bode well for fixed operations for some time. But arguably, what is most intriguing to buyers in our industry is the level of fragmentation that still exists in auto retail today. The average dealer owns less than 3 dealerships, and the vast majority of dealerships are owned by families and individuals. The publics own just 5% of the dealerships, and even the top 150 dealership groups own just 20% of the dealerships. Looking at these statistics, our industry has barely consolidated. As much as we all talk about how consolidated it is, it's actually not at all consolidated. What this means for buyers, especially all that capital that's looking to get into our industry, is that there's tremendous opportunity for growth through acquisitions. No other retail industry in the U.S. is this fragmented and can present this kind of graph. Even better, consolidation is highly profitable because of the increasing benefits from economies of scale. As you can see here, the public's SG&A, or sales, general, and administrative expenses as a percentage of gross profit, is a full 17% on average lower than the average private dealership. Those savings from economies of scale drop directly to the bottom line and become even more meaningful as we continue to see technology and systems play an increasing role in retailing. I mean, look at this. Lithia's SG&A as a percentage of gross profit is 66%, whereas the import stores on average are 91.5%. That is a tremendous delta, and it's the reason why we do continue to see Lithia be so active, by way of example, in the acquisitions that they are doing. They are focused, and if you listen to the most recent earnings call in particular, you can hear them talk a tremendous amount about this delta. Another theme we are seeing with buyers is a desire for platform acquisitions that give them immediate market scale or tuck-in acquisitions into their existing markets to enhance market share. We are seeing more buyers really focused on market dominance and market presence because they believe that as the industry evolves, that is going to be a key differentiator for dealership groups that really own a market. Owning a market enables a dealership group to roll out new strategies, sales strategies, products into a certain market. You heard, for instance, AutoNation rolled out or is trialing Waymo in Phoenix, Arizona. That's an example of how when you have significant presence in a market, you can really start to economize and see ways that you can have economies of scale and scope. Our example here is our client, the Tonkin Automotive Group, who had a significant presence in the Portland market. They were the largest dealership group in the Portland market and represented most of the franchises, and that really drove a lot of the value of this group relative to a group that might be scattered across multiple markets and doesn't have as much market share in any given market. Another buyer theme that we will be discussing in our next report that I should have mentioned is coming out tomorrow. So those on the line should receive a copy tomorrow by email, is that we are seeing higher valuations being paid for dealerships that have unique selling or operating models that are successfully implemented and where a buyer believes they can sustain the model post-transaction. A great example of this is what the one-person, one-price selling model, which we found for the top one-person, one-price dealerships, they are seeing very high revenue per employee, which is resulting in very high earnings and profitability margins. In fact, as high as 40% net to gross and 8% net to sales. This rivals, these level of revenue per employees for these types of dealerships rival an Amazon-like revenue per employee and clearly we know that so much of retail is going to that efficient model. What we're finding in the clients that we've represented with these kind of successful models is that, again, buyers are willing to pay high multiples, even though there's overperformance here, because the buyer believes it's sustainable. The Wilson Mill Toyota Subaru deal and the Edmark Superstore deal, both of which were one person, one price, are examples of that. The final trend that is driving more buyers to market is dealers' increasing willingness to bring on capital partners. Ryan Kerrigan already mentioned that this is a service we do provide to our clients who are looking to identify the right capital partner to grow their business in the future. Increasingly, what we're finding is that dealers are realizing that because scale is so important and they do want to increase their size, but they don't want to continue to risk their own balance sheet to do so, they're finding that the benefits of having a capital partner are starting to outweigh what used to be perceived as significant negatives. In particular, we're seeing that dealers are accepting that it might be actually very positive to have another thought partner as they look to navigate what could be quite a changing environment of operating in auto retail in the future. So OPM, or other people's money, is something that we think will be a significant trend. We think that in the future, most of the large private dealership groups are going to be accessing this kind of professionally managed equity capital to drive the financing of some of their growth going forward. Okay, now that we've discussed why buyers and sellers are coming to market, let's talk about valuation, certainly a very important topic and one that Ryan alluded to in the intro. Kerrigan Advisors today does see a market that actually is at equilibrium. So even though we are seeing more sellers coming to market, there's no doubt of that, we are also seeing more buyers. Interestingly, of course, from the prior slide, in particular, these new investors that are looking to get into the market with all this capital that's out there in private equity. So for now, we are in our view, neither a buyer or a seller's market, but rather a market where both parties are seeing eye to eye and a tremendous number of transactions are getting done. Now, as many of you know, our firm does publish this Blue Sky report, and in it are our Blue Sky multiples. These multiples should be applied to most recent trailing 12 months earnings for a given dealership and assume average dealership performance. Now, given our state of equilibrium, we do not see the current multiples going up or down dramatically in 2018. That being said, each transaction is unique, and there are many factors that play into franchise value. Admittedly, there is more art than science that gets played into when you are looking at what value a dealership should be selling at. Now, in terms of the factors, we really see these 6 factors here that drive valuations up or down. The first being earnings growth expectations. And this is to say that if a dealership is overperforming and a buyer does not think that they can maintain that level of high performance, then often those overperformers' valuations their multiples are on the lower end of our multiple band. Now, the exception, of course, is in my example earlier where you have a one-price store or another store that has a system of selling that the buyer feels is sustainable and is systemic to that organization. In those cases, we are finding buyers are willing to pay more because they want to actually access those selling systems. The other case in the earnings growth expectation is if a dealership is underperforming, meaning they are doing, let's say, 1% net to sales, and a buyer knows that in short order they can get the dealership to 3% net to sales, let's say by cutting costs. In some cases, we are seeing the multiples very high for those stores, although I will say in the case of dealership groups, that does not tend to be the case as much, in part because moving the needle on 13 franchises is not a simple thing, and so the buyers are more skeptical in the risk associated with improving the profitability of a dealership group by turning it around. The next is buyer demand, and in high demand markets, we see higher multiples. In lower demand markets, we see lower multiples. This makes sense. It's really an economics 101 situation. If there's more players looking for deals, that drives up price. If there's fewer, that drives down price. Real estate is a very key component of transactions, as I've already talked about, often the most valuable part of the transaction. If a franchise needs a full image compliant construction project completed post-transaction, that will have a significant negative effect on the blue sky. In fact, more so than we saw in 2017. This is becoming a much bigger issue going forward, and we are finding that buyers are implementing higher discounts because they perceive more risk in the construction project given the timing of where we are in the cycle. Real estate that is image compliant, however, the buyers are very attracted to image compliant deals where they don't have to do anything today. Market vehicle preference also, of course, is a major factor, and this is to say that truck dealerships in truck markets trade at higher multiples than truck dealerships in non-truck markets. Likewise, luxury franchises in luxury markets trade for higher multiples than luxury franchises in markets where you don't have very many luxury buyers. Market representation also matters, and that is single point markets tend to have higher valuations, especially for luxury, than if you are in a highly competitive over-dealered market. This is often a big factor as it relates to some domestic franchises, where in certain markets there's so many other franchises that just drives down the valuation of each of the domestic franchises in that market if it's over-dealered. And finally, customer relations. And this is an interesting one. We didn't used to have very many questions about CSI and SSI, but what we're finding is that increasingly with social media, buyers are increasingly focused on what is the brand reputation of the dealership or the dealership group in the marketplace, because in the social media realm, those aren't easy to change as quickly as maybe it used to be to change a reputation. And so we believe this will be an increasingly important factor in the valuation of dealerships going forward. Here you can see our multiples, which we are going to be publishing tomorrow in our Blue Sky report, so you're all getting a sneak peek. We actually have not changed the multiples from last quarter, and we do think multiples will stay at about this level for the remainder of the year with maybe some adjustments here and there. We are finding is that, again, the pace of the demand from buyers is significant enough, and the health of the financial market and the health of the auto retail market is strong enough that really very few sellers have to sell, and so they don't get the multiples they want. They just choose not to, and that is keeping multiples pretty sticky right now. What you will see, of course, is that in the next slide I will share with you that buyer demand really tends to be the biggest factor in what drives multiples up or down for each franchise. And in this case, we continue to see Toyota, Honda, Subaru, Chevrolet, and Ford as the highest demand non-luxury franchises. We also, as a firm, do quite a bit of analysis of each franchise, and we certainly analyze all the transaction activity that we're involved in and that we know about in the marketplace to determine the multiples and our outlook on the multiples. You can see in this analysis here for the second quarter that we do have a negative outlook right now on Hyundai, mostly because of the continued challenges in sales and loss of market share with that franchise, as well as buyer demand is been relatively low for that franchise. We also have a negative outlook on Chrysler, which continues to have a low buyer demand and is certainly going through some management changes. One thing also to point out is that there was quite a bit of discussion on the most recent earnings call with all the publics on the challenges related to incentives. And what we would just like to say is that when franchisors and OEMs have idiosyncratic incentive programs, dealers find those franchises are more challenging to manage and that profitability becomes more irregular. These irregularities certainly logically lead to lower blue sky multiples, as buyers likewise find it more difficult to project future earnings of these franchises. And so we are going to be more attuned into the incentive programs of each of the OEMs and could downgrade certain multiples in the future if we continue to hear negative press on some of the franchises that we heard about last quarter. Here are the luxury franchises multiples, and you can see this is very much a have and have not graph, if you will. We have 6 that are in high demand, and then 4 that are not as in high. We really don't have a lot of buyer demand, although we have some increasing demand for Volvo. We have a positive outlook on the Volvo franchise because of that. But generally speaking, you can see that really there's 6 that are in high demand and 4 that are in not as much demand in terms of franchise, which is the primary driver of these multiples. Looking more closely at some of the statistics on these franchises, you can see that again, Porsche can do no wrong. It seems there's no question it has the most pricing power in terms of blue sky in the industry. You then have Mercedes, Lexus, and BMW. There was a mention in several of the earnings calls about BMW's incentive programs and the challenges associated with those. So that is something we're going to keep an eye on as it relates to the multiple. And we do hear some discussion with Audi dealers about some of the challenges there as well related to incentive programs, something we will keep an eye on for next quarter. We would like to also point out, and you may have noticed on our charts, that we are reviewing the tariff valuation exposure, and we would just like to reiterate that we can see no benefit from any sort of increased tariff on or high tariffs on imported vehicles and imported parts. Even domestic franchises like Buick would be significantly negatively impacted, and we want to be quite clear that we do think that the franchise values and the buy-sell market would be dramatically affected if we were to see the kind of tariffs that are in discussion right now come through. So it is our sincere hope that cooler heads prevail in Washington and that we do not see any sort of tariff like those being discussed implemented. In closing, while there certainly is tremendous change being discussed in our industry, and some of this change will add and some will subtract from the value of the businesses in auto retail, the fact of the matter is that change creates opportunity. Just like the number of photos exploded with the onset of digital photography and that innovation, it is likely that the number of miles driven will explode with driverless cars someday, leading to a larger rather than a smaller auto industry. But it will be different. So the question for everyone in the industry is, will we be Kodak, who did not adapt to its changing industry, having to file for bankruptcy in 2010? Or will we be Instagram, who saw an opportunity to capitalize on the technology changes and ultimately sold for $1 billion the very same year that Kodak filed for bankruptcy? Today, perhaps more than ever, how we all approach our changing industry will meaningfully determine the value of our businesses in the future, which we believe, as in the case of Instagram, could be a fortune. So with that, we are going to open it up to questions, and Ryan and I are going to answer questions together, and we have some that have come through. So
let's put us on speaker. And Ryan, the first one?
Yeah. Feel free to send in any additional questions, and we'll do the best we can to answer them. Someone had asked about the trade war, which Aaron had just covered a moment ago. And so what, if any, impact do you see in the buy-sell market if, in fact, there's a long trade war? I think it's a very salient question. We, here to date, have not seen buyers and sellers believe that there is, in fact, going to be a significant trade war, so we really have not seen that impacting valuations today. However, just this past week, we spoke with a senior executive at one of the German OEMs, and their perspective is that it's going to be very, very hard to avoid tariffs, at least as it relates to the European OEMs, and they are fully baking into their models very hesitantly tariffs going forward. So if that is the case, I'd say there's two elements of question or risk, and one is just obviously throughput and profitability at the dealership level, which will unquestionably impact valuations. The other thing the OEM, and I'm sure probably the Japanese OEMs are considering as well, and that is how much of these tariffs do they just need to eat into the pricing of their vehicles and try to keep the consumer price as close to possible. I know they're running different pro formas in that case. So still some variables here, but this is a very real issue, and I go back to our opening conversation about the importance of AIADA staying on top of this issue and representing dealers here.
Okay, thank you. And another question is how the small dealer can keep up with this market and the changes that may be coming. I think that our presentation highlights the challenges of that, and as you just look at just the cost of operating. In particular, what's interesting is as much as our industry continues to employ a great deal of technology, what we've found is that technology, instead of becoming a tool to become more efficient and more cost-effective as an organization, has seemed to add a lot of cost because the way we're selling cars hasn't changed that much, and so we still have a tremendous, in many cases, growing staff and yet adding more technology. I think that what we are going to see is that the smaller dealers that work to figure out how to really utilize technology to reduce the cost structure of their business will be the ones that figure out how to remain independent and remain on their own and not part of a larger organization. But you can see that that is somewhat of an uphill battle because as with scale and as technology becomes more important, those outside services and those contracts, of course, become less and less expensive when you're spreading them across 50 dealerships versus 2 dealerships. And I think that's going to be a continued focus of many to see how they continue to economize in the industry and look to reduce costs. I mean, there are many that have said in the past, you can't cut your way to profit. But if you look at the way retail is headed and led by the Amazon effect, really retailers today are fixated on ways to retail at a lower delivery cost. So the way you retail is as important about how much money you make as the margins, if you will. So I think that there's going to be an area that everyone in our industry will be focused on is ways to reduce expense.
Aaron and Brian, I want to just thank you for an outstanding presentation. This information is so powerful. I can't thank you enough. And Ryan, I can't thank you for your recognition, and Aaron, of just how serious this tariff threat is. We want to thank you for the partnership and the support that you give the members. And thank you for the time today. This was extremely powerful information that you shared. For everybody on the line, to Aaron's point, the new Blue Sky report will be out tomorrow. Watch for a link. We should have a link in our first up, if not tomorrow, in the next few days, that will allow you to click through if you're not on their distribution list. If you need more information around that, please feel free and do an outreach to our office, and we'll pass that information over to Aaron and Ryan and make sure you get that complete report. It's one of the best reads in the industry, period. It's outstanding information. Please remember today's program will be forwarded to everybody that registered early next week, so watch for that. Mark your calendars for September the 18th when Federated will join us on dealership succession and estate planning. That promises to be a great program as well. And please, per what Ryan said, make sure and review all updates and correspondence from AIADA on the status of the tariff talks in Washington, D.C. Stay informed and get ready to get active. We're going to need everybody. Again, thank you, everybody, for joining us today. Aaron, Ryan, we apologize on that sticky site on those few slides. But again, thank you so much for everybody that joined us this afternoon. Thank you. Good selling. Bye-bye.
Thank you.